Hi, everyone, and welcome to our Made for YouTube series. I'm Sumaira Abidi, and today we want to focus once again on the Balanced Advantage Fund because this is a category that has seen a lot of traction in recent months. In fact, it's one of those hot ideas that everyone seems to be talking about. So let me invite Anupam Tiwari, so equity fund manager at Axis Mutual Fund, to talk about this category a little bit more, its suitability, and of course, why it's so much in demand. Hi, Anupam. Thanks very much for joining in. And this is a good time to talk to you about BAF because you've also converted one of your funds into BAF. Let me just start by asking you, why BAF is so lucrative.
Yeah, hi Sumaira. Thanks a lot for inviting us here. So basically, we have just changed the name. It's not that we have changed anything in terms of philosophical approach the way we are managing the fund. We used to call it Axis Dynamic Equity Fund, but now category is more known as Balance Advantage category. So that's why we have kind of changed the name. And also, we have done some basic changes in the way we apply our logic or the algorithm, the formula that we use to determine equity level in the portfolio. So this was kind of an mixed occasion to communicate again with investors, and so that's what we have done.
Okay. Anupam, what is the reason for this popularity in hybrid funds, balance advantage funds in particular? Is it just the that the debt funds are giving such low returns that debt plus investors are looking for some alpha here, or is there more to it?
Okay, so reason is slightly different. It's not just return, and if you look at to give you perspective on this, and this is very weird that if you look at history of mutual funds in India as an industry, and you track any mutual fund scheme which has, let's say, 10, 15, 20-year track record, and you look at its CAGR, let's take any number example, let's say X percentage, and you ask any investor for last 10 year, has he got a X percentage of compounding? In most likely cases, the answer would be no. And this is a phenomena which is very spread across investor category, be it new, old, or novice, etc. Another perspective, if you look at last year, the investor behavior that happened in 2020 calendar year, post COVID recovery, as market started going up, people started redeeming from mutual funds, because the fear was that something may happen and market may fall drastically again. So this whole fear and greed story that is playing in the mind of investor makes his returns lower than even the delivered returns of mutual funds. You know, so and the fear is driven more by the volatility in the market. Now, of course, we cannot eliminate volatility from the market because that's the inherent nature of it. But we can create certain products where by using certain systems or algorithm we can reduce significantly the volatility that is there in the product itself as compared to, let's say, the market or let's say the nifty. So that is what this category tries to do. So what it does is that it everybody uses some kind of algorithm. We have some specific algorithm, somebody else will have his own thought process about it. As market keeps on going up, broadly, generally, in everybody's portfolio, equity starts going down, and as market starts falling, it becomes more attractive, automatically equity starts going up. So initially investor were not very I would say aware about this. Now slowly, as this category is becoming prominent, everybody is doing their hard work to explain it to investors. They are realizing, yes, rather than trying to time market on their own, rather than trying to think about whether market is going to fall, market is going to go up, they can use this product where in a very logical manner, in a system driven manner, because everybody uses a system. So we also have a formula where there are certain factors and they determine how the equity level will move. So this system driven approach would be more logical, it would be better, so it will give them good participation in the equity, and it also prevents their drawdowns. So I think this realization is gaining ground, investors are becoming more and more aware about it, and hence this category is getting more and more acceptance in investor.
That's exactly what I wanted to ask you because, as a formal category, it wasn't there until, the SEBI reclassification or schemes. But certainly funds of this variety existed. So that's what I wanted to know that, why this sudden rise in popularity? Is it just that, people are more aware now of this? Because, volatility has always been there, right? It's nothing new.
Yeah, I think since it is now a category, so everybody is focusing on it and trying to educate investor about it, its benefit. So there is more concentrated effort on that part. And also I think what has happened last year, unfortunately most of the investors learn by their own mistakes, and not by others mistake. So what has happened last year, market kept on going up and still they were redeeming, so returns were compromised or they were reduced significantly. And hence now this realization is coming that they can use this kind of product without redeeming, without selling everything, and automatically things would be adjusted in the portfolio. So I think both are combined reasons.
Mhm. In fact, people who are watching would also be keen to know that India's largest NFO yet was an NFO in the Balance Advantage Fund category, which marked up 15,000 crores. So, it's just testimony to how popular this category is. But Anupam, is it just for, new investors or investors who are not so savvy, or is it a mainstay even for the savvy investors?
No, I think this category is for every investor, because every investor has some kind of money which he wants to park in low volatile product or low volatility product, and still he wants to participate in equity. Because if you see in India, even if people are allocating to equity, their allocation is kind of underutilized. They are under allocating to
Hmm.
equities. They are not confident about it. And what happens is when market starts falling, they feel it will fall more. Everything is going to come to an end. So let's not invest right now. Wait for an opportunate time. And unfortunately, that opportunate time comes when market starts going up, and then they start thinking that it has already gone up. So there is always this kind of under allocation to equity. So for novice investor, new investor, of course, this is a good entry point. But even for matured investors who have already created wealth in the market and they still have under allocation, this is a very very good product to increase their allocation to equity part. And for those investors who have already have a significant part of allocation to equity, those who are investing in equity for last 15, 20, 25 years, and now they have a good apportionment in the portfolio, so they can shift slowly, from pure equity products to these kind of product, so that a reasonable part of their allocation goes to low volatility product, and they still get reasonable participation in the market. So I think in my opinion it suits everybody. It's a conservative product, so there is no harm keeping this as a good allocation in your portfolio. Of course, you may drive your own allocation to it. Somebody may like it to be 40-50%, somebody may like it to be 15-20%.
Fair enough. Anupam, the other thing that I wanted to, speak to you about is that, there was a time when people would just pick funds. ये अच्छा लग रहा है, invest कर लो, वो इन्फो आया है, सस्ता है, ले लो. Now people are a lot more evolved, right? Investors are a lot, there is a certain thought process behind portfolio construction in a lot of investors that we see on our shows. So therefore, are there some type of funds which are more suitable to go with BAF? I mean, how does it optimize the portfolio? Should you, depending on what is the allocation that an investor might have given to BAF, do you add on equity funds? Do you add on debt to it? Do you add on hybrid to it? I mean, what will optimize your portfolio if you have a balanced advantage fund as a core holding?
Yeah, that's a great. Unfortunately, in market people in mutual funds, people spend more time analyzing economy and stock market rather than analyzing the products, and that kind of hurts them because when you are investing for 8, 10, 15, 20 years, it doesn't matter what is happening in next 12 months or 18 months. But nevertheless, so see, what this product does is that it controls volatility in your overall portfolio. So if you are comfortable having higher volatile product combined with this and getting a net average lower volatility, then maybe you can add mid cap, small cap to your portfolio. But if you don't want that kind of risk in your portfolios, then I think multi cap or flexi cap approach would be the best. I'm a hardcore equity guy, so never recommend a debt fund. And I have no idea about those products. But I think, as far as if you have a reasonable allocation to this product, you can very well have selection out of flexi cap, mid cap, or small cap.
Hmm, hmm. Okay, fair enough. The other thing is that, even within the hybrid space, there are so many to choose from, right? I mean, even in Balance Advantage now, there are so many schemes. So for an investor who, on the face of it has decided that I need, some hybrid, A, how do they select which hybrid scheme works for them? And B, for somebody who has narrowed down on a Balance Advantage fund, what is the differentiator between the various schemes available?
Okay. So broadly, generally, there are four kind of product, in hybrid. So one product, what we call is regular saving, etc., or income saving kind of product, where broadly equity moves between, let's say, 20 to 30%, and balance is debt. Then there are product which have equity between 40 to 50%, roughly around that. And then there are a hybrid who have equity between, let's say, 65 to 75 kind of thing. So these are three broad categories where allocation to equity is fixed and it remains constant almost at all the time. Then there is a dynamic category or balance advantage category where it can move between, let's say, 0 to 100. Some people may have 20 to 80 or 30 to 80, something like that. But it moves depending on certain parameters. So if you really want a fixed allocation, yes, you can go for those products. But if you are not sure what type of allocation you want, or you want to have a more participation in market in a rising situation and less participation in a falling situation, then I think dynamic or balance advantage approach is the best approach, because this solves all the problem for you, because equity will keep on moving, so you don't need to put your mind into thinking what should I do. And also it gives you better equity participation as compared to, let's say, a product where equity always remains at 20-30%. So you get more participation in the equity market, so that's a better product. And it also kind of does things on its own in a very logical manner, so you are assured that okay, things will move on in a right direction.
Anupam, the other thing is that, for equity funds, SEBI has given very strict guidelines about, what kind of equity exposure you can have, right? Likewise for debt funds. Now, balanced is a category where there are no guidelines except to say that X amount should be in equity and, the relationship between equity and debt. How can a person be assured that, the overwhelming exposure is not to say small caps within the equity, and likewise for credit, that what is the credit quality now? We'll focus only on equity, or is it that the industry themselves, the fund managers themselves, want to keep a higher exposure to say large caps? I mean, what are the trends and what can an investor be wary of in fund selection?
Yeah, I think everybody accept the fact that this is slightly conservative strategy that investor wants to have. So the essential idea behind this product is to control risk in overall portfolio of investor. So, for example, we are significantly large cap oriented in the portfolio, and even on the debt side, we try to control credit quality in terms of, let's say, keeping more than 50% in AAA. So that's what we do. And even on the double A side, we keep the duration quite low, so that we are not carrying risk for a longer period of time. So that's how we do it. And of course, I think industry wide this is a similar kind of approach, philosophical approach to manage the portfolios in this category.
Okay. Just one final question. Because there is so much work going on, I understand that, there are models which also facilitate this, but certainly the fact that you have two fund managers working on it, would it drive up the expenses and therefore lower the returns? I understand that returns are not, the prime factor here. It is, covering your risk. But even then, you think having two fund managers will drive up expenses?
Actually, two fund managers do different job, right? One guy manages the equity, one guy manages the debt. And generally what happens is that in any asset management company, there is a proper approach. There is a system which decides how things will be managed, what would be the criteria, what kind of portfolio we want to create, And so everybody works within those constraints and within those limits. So it's not that once you appoint a fund manager, he can do whatever he wants. But we have a proper investment philosophy for every product, where everything is clearly defined. Then it's just that how you will pick individual stock, how you will manage risk, that is left to the fund managers, or in that side what type of paper, etc. But broad guidelines are well decided in advance, and they are reviewed also in the investment review committee, etc. So this doesn't matter, because everybody does his own job within his own part of the AUM. So whether you have two or three, it doesn't matter at all.
Okay. Anupam, thank you very, very much for explaining this category to us. And of course, the key point remains that, first look at managing risk and then look at returns, and which is what the BAF product does, something which is suitable for all seasons and all investors. Anupam, thank you very much for your time.
Thank you.
So I
Thank you,
hope
Sumaira.
Thank you. So I hope this has been beneficial to everybody who's been watching. If you have questions or comments, do write into us. And also, if you have suggestions for videos that you'd like to see in the coming weeks, we'd be very, very happy to take those up. Thanks for watching. Stay safe.